for me, the conversation is always, where are you right now? Where are you wanting to go? And then after I understand those two things, what are the resources we have to work with? And what are the future expectations?
Yeah.
Can we, and then there's all this opportunity, but if you just think like, well, I'll just take money out of the account, there's so much more at play. Like if you're listening to this right now and you're thinking, I have a beneficiary IRA, I'm just going to take the money out and spend a little bit each year. And at the end of 10 years, there's going to be no money. Please, please, please get some quality help. You're leaving a ton of money on the table. And going back to what I had just said, somebody wanted you to have that money so that it could better your life. Yeah. No one, I promise, no one in the history of anyone has ever left somebody an IRA or a 401k in a tax-deferred place that they said, I want to leave this money to somebody so that they can give as much of it as possible to the government in taxes. No one has ever done that.
You know, I've never seen the IRS named as a beneficiary on the beneficiary form. Have you, Brandon?
I have not. Although I have seen I've seen no shortage of like TikTok videos and social media things that play into these misconceptions about the tax planning side of stuff that say, basically if you do have a tax deferred account, you've named the IRS as a beneficiary. And that's so wildly untrue. They just don't understand tax planning.
Which is huge.
They take a very simple thing and they blow it up and make a catastrophic, mountain out of a little tiny molehill. Yeah. Anyways, that's so funny about the beneficiary. I'm going to remember that.
That whole opportunity of choice is huge when you have sudden money, right? We will do an exercise called anything, not everything.
Okay.
And you probably do something similar where you can list out all the different ideas of what you could do. Let's say that beneficiary IRA, or like, what can I do with all this money? And then scale back and say, okay, you're in a position where you could do anything with that, but you probably can't do everything on this list. So how can we structure it that it can be more tax efficient, that it also can be something that's a lasting gift from someone who loved you, that named you as the beneficiary, and build out that choice. But getting back to the brain dump and that whole idea, you got to be able to address all these other things that are going on emotionally and just whirling in your head to move forward and make good decisions.
Anything, not everything. That is always such a interesting principle. Have you ever talked to somebody out and about that are like, oh, if only I had $1 million, and they think like that's the epitome of like, you could, have it all if you have $1 million, and you're going like, that's kind of what most people have when they go to retire. Right. And sometimes you even talk to people that have that, and that's their retirement account or whatever. And they say like, I have $1 million, and they're feeling pretty good. And you're going, yeah, you can do just about anything you probably want. You just can't do it all. And you can't do it all forever.
Right.
So you have some major flexibility. But you better pick and choose, because depending on how you choose to play this, you may be retired for 4 days and find yourself back at work.
Exactly. See, people who look at that $1 million, they're thinking about it in the bank and how much can I buy with $1 million?
Yep.
That's the wrong, I think that's the wrong perspective. That's going to lead you into trouble.
Yep.
Whether you're talking a retirement account or sudden money or anything, $1 million should be looked at as the base of an engine.
Mm-hmm.
How much can this engine create for me to, like, on a year-to-year basis, right? Of replacing a paycheck or providing an income, not as $1 million as a chunk, but as an engine that's got to generate.
I think this is one of the great ironies of why people have done well with real estate investing. I'm not endorsing, I'm not recommending that everyone just start real estate investing by any means. Oh my God, there's a lot of risk. Now, calculated well, it can be a viable strategy. But I think the reason people do well with real estate investing is because you take all this money and you put it in the home and you can't check the dang account balance. And so every real estate investor you basically ever talk to, they talk about one thing, the dang cash flow That's what they care about. They say, I get this much in rent every month, or, after all my expenses this last year, I made this much. And they care about the tax advantages of it. They care about the cash flow of it, and also it's kind of like setting up a retirement plan for them all in one, in the sense that they're looking to have some tax advantages and they want to turn this asset into income. And
yeah, but I think you're totally onto something there, because it's just how it's viewed.
So it's a behavioral thing. It's not that real estate is like provided this, just whatever asset class that.
Right. It's really not a magical asset class, but because people understand it as an income producer
instead
as
of
opposed
an
to just
balance.
a chunk of money. Mm-hmm. Yeah, that's a psychological behavioral thing that's such a huge difference.
So they just stick with it and they don't look to see.
Yeah.
But what's interesting is when you look at people with a primary residence. Okay. So now it's not an investment that they just said, hey, I took my big bonus from work, or I took this inherited money, or whatever. I had this chunk of money. I bought a rental property and I'm just kind of letting it do its thing, and, whatever. And I'm happy because I have tax advantages, and I'm happy because I have cash flow, and, that's great. But when they go to their own personal residence, how often do you see it that they look at what their home is worth and they say, gee, I only owe $100,000 on my home. It's worth $700,000. That's so much home equity sitting right there. I really could cash it out by a boat. Whatever. There's so many things that, and you're going from a financial planning standpoint, you're kind of scratching your head sometimes going, what's really nice when you're retired and don't have an income is not having to make a mortgage payment. But I digress. Yes. The point being, it behaviorally gets looked at differently. When they go view it as like, well, it's not producing cash flow, right? Because everyone that has cash flow on an investment property, they can look at it every once in a while and say like, man, this has really gone up in value. But they know that if they, do that cash out refi or they sell it, it turns the cash flow off. Mm-hmm. And that's what they cared about. Mm-hmm. They typically care about the income. So behaviorally, it's kind of worked for people in that sense. Mm-hmm. And it's not really particularly any different than owning, like, and I got to be really careful how I say this, equity, right? And rather than equity in a piece of real estate you own, it's equity in a company that pays a dividend, right? Mm-hmm. Now, not all real estate is created equal. Not all companies are created equal.
Right.
I don't want to delve into, how
we realize there are flaws in the metaphor.
Right. Yeah. I'm just saying, like, I'm not, recommending one over the other, or a certain, company over a certain type of real estate or anything like that.
Right. But as a tool, it can be used in a similar way.
It's the same idea, Yeah. It's just that when you own shares in a company and they trade on the market, you get a daily valuation. Heck, you get an intraday valuation a lot of times that says, if you sell it all right now, here's how it plays out. And can you imagine, I've always had this theory when it comes to like real estate, that if you could, if you got a notification on your phone every time the valuation changed, or mm-hmm. some algorithm could change the projected value of your home, people would like not own homes. Right. Like if there was like a Robin Hood version of your home values, and it was just like, your home's worth $10,000 more today than it was yesterday. Oh, your home's worth $30,000 less than it was, last week. And and you're constantly having to like look at it. Yeah. And you're going like, oh my gosh, and it drives those behavioral changes. But I've just noticed this weird thing.
Yeah. I think you're onto something there. Anyways. Absolutely. So, because there's too much emphasis on the day-to-day changes of something like a stock or something that's more liquid of an asset than a home, right? Mm-hmm. There's too much information out there, and people get all excited about those day-to-day changes that really, just like the home, the day-to-day changes, it shouldn't matter so much. I like that metaphor that you got there.